Okay, so two quick housekeeping things. First of all, please like the video if you got any value from it. Please subscribe if you haven't subscribed. Feel free to share the video and comment if you have any questions. We answer them very quickly. Um, so please like, subscribe, and share, comment. These things help us. Second of all, as you can see, our next meeting, we have a monthly meeting. It's almost always the third Thursday of the month. It will be Thursday, March 12th, 2020, at the standard place that we always have it. It's the VFW at 65 East Merrick Road in Valley Stream, New York. Everyone is welcome to come. We're changing the format a little. The first hour, 6 to 7 p.m., is going to be newbie hour. Anybody can ask any questions they want. And then the standard format will be from 7 to 9 like we had before, with networking, snacks. We'll have a short presentation, a great presentation this month at 8 p.m. And then everybody's got to get out of there by 9 because that's when they throw us out. So we're talking today about what happens when the market has a downturn, right? So I wish I could tell you that I was in this business when everything hit the fan in 2007, 8, and 9. I was in the mortgage business, so I had a completely different perspective on it. But I can tell you that I'm part of a group, you can see my Investor Fuel shirt, with a lot of members that were in it when everything hit the fan. And some of them had huge problems. Some of them declared bankruptcy. But they got through it and they're still in the business now. And what every one of them said is that when everything hit the fan in 2008, 2009, that it was the absolute best time to buy properties. And what I'm getting at here is that, well, first let's just talk about the market, right? So we're in 2020 now. We're February 2020. I'm guessing a lot of people don't know, but the highest end parts of our market, I'm talking about in New York, in Manhattan, in the Hamptons, in the most expensive parts of Nassau, like Old Westbury and Laddingtown, the most beautiful parts of Nassau, the market's already had a downturn. It's already been going down for a while, like a year or two. And some of those things are down 20% off their highs. And ironically, not ironically, but logically almost, the lowest priced areas of Long Island, so I'm talking about in Nassau, Roosevelt, I'm talking about Wyandanch and Shirley, Mastic, and Suffolk, those areas are going up. They're just doing better. Hempstead. And that's where we're going right now. That's affordability is selling. But inevitably, at some point, right? Because let's say the bottom here, I think, was 2008. I mean, everything really dried up mortgage-wise when I was in it in around 2008. We're 12 years into that, and most of these things are 7 to 10-year cycles. So it should have a downturn. Now, I don't think it's going to be like it was last time, right? Because that was an artificially inflated, absurd bubble that a lot of people in the mortgage business were responsible for. I don't take any responsibility for that because I worked for a company that's still around and that was very irresponsible. We didn't make crazy loans. We didn't do 50 loans for a bus driver with no income. But so that was a huge drop. We saw 40% drop, 50% drop. I don't think we're going to drop that much, but I think things are going to go down. So the question a lot of people in this business have is what's going to happen when the market goes down? They're terrified, right? And we spoke at the last video about excuses. And I think this is also an excuse, right? It's an excuse to not get started. Here's the truth. Once the public perception, once the media sort of starts reporting that, hey, the market's on the way down, the real estate market's going down, and people believe that that waiting, that not taking an offer now is going to result in them getting less money if they wait going forward, it changes our ability to buy houses in a big way. Because that's not the case now. Most sellers believe that if they wait, the market's going to go up, and that waiting's in their best interest. If that perception changes and they believe that waiting's not in their best interest, it's going to make buying houses easier. Now, of course, if we're in a down market, you need to adjust the price you're going to offer. Of course, right? If the market's going down, you need to assume that the ARV, the after repaired value, is going to be lower than it is now. Pretty much for the last, I mean, we've been doing this since 2013. The ARV, we just always assumed it was as is. So if we comped out a property and we looked at it was selling for a fully renovated property was $400,000. We assumed $400,000. We didn't say, oh, it's going to be worth more because it's going to take us 6 months to get this to market because we don't know where it's going to be. And sometimes the market really saved us. Sometimes it really did, right? There were times when we screwed up, we overbuilt. We did that a lot the first 4 years we did this. Spent too much time on it. But the market saved us. So we probably should have broken even, and we made our 30, 40 grand because the market went up. But if it's on a downturn, you sort of have to give a discount for that. Take 10% off, right? Things are selling 400 now. I'm probably gonna have to sell this house for 360. I don't have to tell this to a seller. I'm saying this is in your mind. I'm gonna have to sell this house for 360 because it's gonna take me 6 to 9 months to get it on the market, and the market's on the way down. You got to figure that in. So you got to obviously figure that into your price on the way down. But the sellers will be in a different mindset completely if they honestly believe that the market's going down. And that usually is media related, where the media and the newspapers and television are reporting, hey, we're in a downturn, the market's going down. If people believe that, it helps us. So I personally can't wait for it to happen. I know it sounds strange. Again, I don't think it's going to be Armageddon like it was in 2008. I think market's going to drop. It's going to drop 10%, drop 15%, maybe 20%. That's fine. That's great. It's amazing because there's such a huge lag between public perception and reality. So I feel very strongly that if you're doing this and you're worried about the market going down, you're worried about nothing. It's just irrelevant. It's another fear that's trying to push you away from doing. I mean, if that's what's holding you back from starting, it's just BS. So I think I welcome the market going down. It's something that has to happen. It has to happen, right? It's just a supply and demand. It's a cycle that's been happening for 100 years. It's going to continue to happen. It's just a question of how much and for how long. And it's very hard to know that. It's very hard. It's nice to say that someone who's going to predict it. Nobody who predicts it is on the money right. Even the people that predicted what was going to happen in 2008, 2009, a lot of them were very early. A year or two early. If you watch the movie Big Short, I love that movie. These guys were getting yelled at for years by people because Wall Street would not capitulate that they were holding tons of crap. And it's what happens. It takes a long time for things to happen. No one knows exactly when it's going to happen. But I really don't think we're going to see enough of a drop that if you buy a house and you fix it up, you're going to take a beating on it. You may break even, you may lose a drop because the market fell. It happens. It happens. And most markets are really specific to their own area. They're very local. But you got to, if this is the business you want to be in, you can't worry about market cycles because they happen all the time. So that's my 2 cents on what happens if the market drops. And if you have any questions, our number's below. We're happy to help. Again, subscribe, like, share, comment. It helps us a lot. Thanks.